All right, start them like we always do, mate. Crack a beer. Oh, that's
Crisp.
Friday morning. All right, here we are.
What's the timestamp? Friday morning, 10 a.m.
Here we are back at Beers and Buying. Back once again with the lovely Brad Haining from Arch Brokerage. How are you, big fella?
Very well, mate. How are you?
I'm good. It's Friday. We're, geez, I can't wait. I can't believe we are actually a quarter of the way through the year already. I know that things have been pretty crazy.
Yeah.
But mate, the reason, obviously, we've been doing a bit of a series of this just around things and important things for home buyers, people that have got mortgages. It's really just a bit of a learning curve about various topics. But the one I kind of want to focus on today and discuss was refinancing. So I thought we could firstly break down a little bit about, what is refinancing first and foremost. And then obviously what you can do when you refinance as well, and maybe why you'd refinance. So I thought probably the key one and probably the most common one we've seen is people refinancing, based on rate. So did you want to kind of just start off and touch on what that typically looks like?
I think that's your, if you ask everyone, it's about moving banks to get a lower rate and that kind of thing. And most of the time, someone will come through and they are on a higher rate, and then you sort of uncover, the other needs and that kind of thing, which is, I think we sort of went off you got debt consolidation, you've got people that are doing minor to major renovations, people looking to invest, and that could be shares, that could be something for their business, which is, I guess, you have that conversation up front so that you can sort of place them with the right bank.
Holidays, weddings, cars, caravans. It's crazy.
Yeah,
it's not
travel weddings these days when people are spending 50 to over 100 grand. Sometimes people will pull cash out as well for school fees. If they can pay school fees, private school fees are
good point.
Are massive and on the rise. And if people, sometimes schools are giving them a bit of a discount if they pay years in advance, so they've got the opportunity to do that while they've now got the borrowing and also the equity as well. So, I think most people would sort of think, try and save 0.5% on your home loan and that kind of thing, which is sort of the obvious and easy part.
Yeah.
But then I guess as you dig a bit deeper, that's when you start to look at which bank you're actually going to go to and why, because one of those things that you may be doing on top of just trying to get a better rate can sort of affect where you end up landing.
Yeah,
depending on the purpose.
For sure. And I thought one really handy thing for everyone that's listening and watching at home is if you've got a current mortgage, very simplified version of figuring out, well, what could I actually save in moving between banks? Because at the end of the day, really it's based upon making sure the client or the person is getting a financial benefit, right? Mm-hmm. You don't want to be refinancing for the sake of refinancing, because at the end of the day, being if it's a variable loan, obviously it changes from state to state with the costs. But ultimately, it's usually it's about $700 or $800 to refinance, right? Just from a cost perspective. So what you want to make sure is that anybody out there that's listening that maybe has a mortgage at the moment that's consider refinancing, you just got to make sure that the interest savings is going to outweigh any costs that you do in actually moving between lenders. Now, for anyone that is at home and wants to pull out a calculator, I'll do a real quick equation. So let's say you're on 6.5%, you're going to a rate of say 6%. You got a 0.5% difference, right?
Yeah.
So what you want to be doing is, let's say you've got a $500,000 loan. You then times that by the difference in interest, which in this instance would be 0.5%. And that works out to be $2,500 in interest savings in year one. Now, that obviously doesn't take into account amortization and all those sorts of things. Yeah. And $2,500, that's reasonable savings. That might be someone's pay packet for a week or a fortnight. And so I think one of the key things, obviously, that we look for, isn't it really? It's a matter of, then there's a snowball effect to that as well. That's year one. Obviously, it's not going to be $2,500 every year, because your loan's normally going to amortize and go down when you're paying it down. But it does then have the compound effect of, okay, it's $2,500 here, might be 2,200 the following year, and so on and so on. So obviously over time, over whether it's 30 years or 25 years or whatever it might be, there's obviously can be astronomical savings in moving between lenders.
Yeah, and I think one of the other things to look at, we see it all the time, is, someone comes through, they've, even like now, they bought their first home, so they had a 30-year loan. 2 or 3 years down the track, they're looking to do something that maybe the current bank doesn't accommodate, whether that's through valuation or what the purpose is. And then, one of the main, whether it's like through us or coming from someone else, is making sure that they stay, especially with an owner-occupied loan. Investment's a little bit different because you can play with that a little bit more, but especially when it comes to owner-occupied debt, that's not tax deductible, is making sure that your loan term remains the same. Because, we see people that come through that, they've had the loan for over 20 years and they've got 22 years to run. Now, granted, sometimes you need to stretch that out for certain things, but if you're paying off a car, you can do a smaller loan split over, your car's got 4 or 5 years to go. You can do it over that term. Refinancing a couple of car loans to a few percent lower is actually not going to save you any money when you pay them off for the next 20 to 30 years and that kind of thing. So,
unless you've got then the discipline to go, okay, well, you know what, I knew that repayment was $500 a month or whatever it might be, I'm going to stick to that.
Yeah. And we can see as brokers as well, clients that are already with us, we can see them repaying their loan. Are they a little bit ahead? Just so, if they did happen to fall behind, we can see that and provide some help as well. But if you see that they've had the loan for a number of years and they're just making the minimum every month, then you sort of know you don't want to put them in that position because they will continue to maybe pay the minimum. And in the long run, it can work out to be hundreds of thousands sometimes if you're paying off the loan over such a longer period of time.
I think there's a bit of a and I think sometimes we definitely see obviously some of the scare tactic campaigns of, don't refinance. Why would you refinance? It's all a myth. But at the end of the day, if you're doing it in the correct way, there is 100% money to be saved. No, you don't want to be extending back over 30 years, obviously talking about owner-occupied debt. You don't want to be extended back over 30 years again. In some instances, some people might need that for cash flow.
Yeah.
Like we've seen that in the past, and we're not talking about going from 20 years to 30 years, but maybe they're a couple of years in. Maybe they've then factored in a renovation. They're young enough. They kind of go, look, we understand
The value
right
of the home
now.
is increasing. It's sort of,
Absolutely.
you can justify it.
Yeah. And I think for people, it's just like, obviously we've been in a bit of an interesting space in cost of living and all those types of things. Interest rates have gone up. So I think there's just been an adjustment period that's come with that. But I think ultimately it's just a matter of just, if you can try and match what you currently got, then you really are comparing apples with apples, and then you see the real saving that's there. So for anyone that's listening that thinks maybe refinancing is a bit of a myth, there is actual value in it.
Yeah, I think if you, if you're with Bank A, who gives you your first home loan, and they're willing to help you with, even if they tick off everything you're looking to do, you invest in this, you renovate the house, you do this, that, and the other. If you're with that bank the whole time, let's say it's 20, 25 years, you're not, although, they've helped you out, with the funds and that kind of thing, you've probably lost out in terms of like what you've been paying and things like that as well. Because I think, refinancing isn't what it used to be as well. Like it's a much quicker process. People talk about like, oh, I've got to move all my stuff. There's tools now to help you switch all your direct debits in a matter of minutes and that kind of thing. So it's not that hard, but I think there was definitely this, didn't want to move and that kind of thing for a while. But if it's worthwhile, I think you need to definitely consider it. And also, I guess if you look at, you could stay with that bank, and again, like they'll help you with everything. But what if you went to Bank A, which was going to value your home higher, because the banks will give you a rate up to sort of 80%. But some, if you creep below 70%, some if you creep below 60%, you could find yourself, you're almost 0.25% better off, and
Yeah.
all because they've given you
A high
a
value.
better valuation.
Yeah.
So everything remains the same. You're still paying a bank every month. You still have an everyday account, which are nearly all identical these days.
Yeah.
But you've saved yourself just by giving someone a call and getting a valuation done, which takes 5 minutes.
Yeah. No, absolutely. All right. Well, let's and so I guess that in a nutshell, that's typically what we would look for refinancing, right? It's like matching up all the numbers, and there are plenty of clients out there that, and I think what we've always got an obligation to do is whoever that client is with presently, whether they've been introduced by us as brokers, or maybe they originally did their loan with a bank, or maybe it was with another broker, I feel like we've always got that obligation to first and foremost check, well, hey, what can you actually do for your current client?
Yeah.
Right? So maybe they're on a rate of 6. Yeah,
sometimes.
exactly. Yeah, exactly. They will. So it's kind of like, that's always like I know for us, it's always a first stop. Well, okay, we're on 6.5 at the moment. Okay, well, we know in the market that you could be getting cheaper than that. So Bank A, what are you going to do for us first and foremost? We obviously obtain the best rate that they can. We'll compare because we know what's happening with the market and what's happening with interest rates. And so really it's just a matter of like, well, what can you do for that client? We get their kind of best and final. And then obviously we conduct research and go, well, okay, Bank B, C, and D are saying that they're going to do this for you. All right, well, how do the numbers stack up on that? Well, you know what? You're actually better off staying with Bank A, or it could be a matter of like their interest savings are just far too great here. These are the options. What do you want to do?
Yeah. And I think, whether it's like client comes and says, I'm going to be looking to purchase an investment property, maybe in like the next sort of 3 to 6 months, we can start to sort of forecast what that looks like as well. Because this bank might be really great right now and they'll want your refinance, but they're not going to support your investment purchase at all. So you already know you're going to have to look outside of that, which is, I think, why it's important you have that conversation up front of, the refinance. That's all sort of easy ABC stuff. But like, what are you looking? Is there anything you're looking to do? Anything coming up?
Yep.
Because then sometimes you switch from this option to that one.
Yep.
Pretty quickly.
Yeah. And I think what's going to be really interesting is what's going to happen when these RBA rates continue to come down, providing that they do. But from all senses, that seems to be the direction we're going to continue to head post-election. Not saying it's going to be, I'm not saying it's going to be 1 or 2%, but it sounds like there's going to at least be another couple of drops. Obviously, depending on the data. But what's going to be really interesting, and me and you both know this from our time working in the banks, is when those second and third drops do come, because we've had our first, are the banks going to pass the rate on in full? And do you want to just obviously maybe just touch on a little bit around what we mean by that when we say that?
Yeah, so obviously when rates go up, the banks are going to pass it on in full.
So that goes up.
Yeah. So, and then I guess as, and traditionally you can look at this as well over, a large number of lenders, rates go down, especially the first time after a long time, people are really feeling it in the hip pocket. No one would have been game to not pass it on. And you'll find that they'll pass it on at different times because, a major bank passing it on 4 or 5 days later, well, to them, like that's tens of millions of dollars. So they look at that and then you'll start to see those times change as well, like as rates drop. Like if everything dropped again, you may see that they're all passed on again.
Yep.
But I think my take would be if we got to that third one, whenever they list out those 20 banks, there's just going to be some that don't pass it on in full. And that'll range from, it might be 0.2,
0.15.
Yeah.
Yep.
And that's when the outrage will start and that kind of thing as well.
Yep.
And also you want to make sure that, if this bank, some banks, they might not pass it on in full, but still have a bit of a lower rate than this other bank who has been higher the whole time.
Yep.
So you have to sort of drill down into it a bit sometimes. But I think by, if we have another one, it'll be fine. I think on the third one, you'll start to see that it's probably not passed on in full.
I was actually reading something this morning, and it said that they were looking at historically when the second cut comes in for something like this, obviously where we know there's going to be a few cuts, and the data did suggest that on the second cut sometimes that we'll see quite a few lenders maybe not pass it on in full. In saying that, but given the circumstances and cost of living and everything going on right now, I probably do tend to agree with you, Bud. I think it would be not suicide, but far out. It'd be a pretty bold move not to move it on in full, particularly just with how everything's going at the moment.
And even if again, looking back to, well, maybe they've still got a bit of a lower rate. You go and ask everyone on the street, but they don't care. It's always, and I think from our time working in the bank, decisions get made, and okay, it may seem logical to everyone here, blah blah blah.
Yep.
If it doesn't pass the pub test, and everyone's bullshit radar is at an all-time high, and now they just see through all of that stuff. I just think that people will. I mean, they don't have to be loyal to the banks anymore. That there'll be a number of other lenders that traditionally for most people could help you out. So it'll be a matter of whoever's game enough to not pass it on the first time. They'll see an exodus for sure of clients, and it'll be your everyday mum and dad and all the workers and that kind of thing, because they just feel like, okay, if you're going to take the piss, I'll go somewhere else. And there'll be a number of other banks that have great offers out there that will gladly sort of take them on board. Really. So it'll be interesting to see. Obviously, you got the Trump tariffs this week, which if that tightens up, I guess at a bit of a higher level, if that tightens up costs and that kind of thing as well, does that bring the next rate drop forward a little bit? I know obviously they don't want to be doing anything before the next election because they'll both use it as a bit of a weapon. But post that, if costs are high, hopefully that's when you'll see that next sort of drop and that kind of thing.
Yep. Perfect. Let's go back to some of those options that we were kind of talking about earlier, and why someone might refinance. Just thought we could probably break them down a little bit further. So, let's start with maybe debt consolidation. So let's say I came to you and I said, Brad, I've got a home loan, I've got a credit card which I'm paying 20% on, and I've got a personal loan here that's not secured to a car that's 15%. Just take us through and take the listeners through what the benefits might be, and obviously kind of rolling that thing in.
Yeah, I think obviously. So you already know, I'm paying 3 to 4 times the amount of interest that I should be. So, making sure that they're maybe consolidated into one separate loan. So you don't want to have that over, if you've got 25 years to run, you may, depending on what your credit card balance is and what's sort of going to be manageable, you may have a 5 to 7 year loan off to the side, which is your credit card and your personal loan. And then obviously look at, what are you going to be doing with that credit card? Or are we going to be circling back here in 12 months' time doing the exact same thing as well, which, you can't force people, but if you can if they see, look, I've already racked this up pretty quickly, then you just want to make sure that they're not paying that off over a super long term. That's something that we always talk to them about. But having that separate, and, maybe whatever the repayment they're already making on the credit card and the personal loan is manageable for them, which will be a lot more than what their repayment on the home loan would be. So you can actually get them to keep their repayment the same and start to chew into it a lot quicker. So they're not going to pay it off in 7 years. They might pay it off in 3 or 4. Because that interest saving, you'll find, will really accelerate paying it down, especially if your repayment is already manageable.
And you find that with those credit cards, the minimum monthly repayment really doesn't cover a whole lot.
Well, have a look at the bottom of your statement. I don't know if it's, I try not to check mine, but if you look at the bottom of what those statements used to say, it would say, thanks for, this is your minimum $330 this month. And if you pay this off, and don't spend anything again, in 26 years, you'll have this paid off. It's with all the interest charges, because they are, some of them are between 18 and 23% and that kind of thing. Because people have these rewards cards that they're not really getting any rewards out of because they haven't managed it, how those ones in particular need to be done. So
Yeah. And that's really good point. Obviously, slightly off topic, but anyone out there that has a credit card that's got a home loan, really, if you're looking to utilize that the best way possible, you should be clearing the statement balance. And the banks are so smart these days, you can have the auto payment set up. But if you clear the statement balance at the end of the end of each period, it means you're not paying any interest on the money. And really, you should be utilizing your credit cards for things like, bills, pretty much everything that you can put on the thing without it being some sort of a cash advance. You should be utilizing your credit card for that. Once again, providing that you are good with your budget, because often what we can see is people get a credit card and they can go bonkers on it. Yep. And then all of a sudden it's like, oh shit, I've got 20 grand worth of debt on this thing. And I don't have the funds to pay it off. But the whole idea of using the credit card is, let's say you've got an offset account with your home loan. You've got your money sitting in the offset account for longer while you're using the bank's money, and then you use your money from the offset account to sweep into the credit card when the payment is due, and therefore you're not paying any interest on the credit card. So you've saved the interest on your offset account, and then you're essentially accumulating points on the credit card. So once again, bit off topic, but anyone that's got a credit card out there and probably wants to know a bit more, obviously feel free to reach out to us. But you just got to make sure you're using them the right way, and you don't get stuck where you are paying 18, 20 plus percent, because it does become increasingly difficult to actually clear the thing.
Yeah, and I think with your refinance, you've got your credit card, any other kind of loans. If you are pretty sort of savvy around it, or you don't have to be. If you ask the right people the right questions that can help you, you can actually have everything that you've got work for you. And that's why some people that, they rack up a big credit card bill every month. But they know where it's all going. They've got maybe a large amount of home debt and that kind of thing. But they've dealt with the right people, so they actually sleep a little bit better at night, because they know that they're actually getting a really big advantage out of it.
Yeah, for sure.
Because the flip side of that, you start to fall into like financial stress and that kind of thing, and that's not a good spot to be.
Yeah. So essentially, to round that out on debt consolidation, it's the high interest stuff. The idea, roll it onto a loan that you're obviously paying much less interest, and you kind of, if you can, you'd split it out. And have it over that shorter period. So once again, it's not being paid to 30 years, gives people, something tangible to knock down, because sometimes people might get in the rhythm of going, well, you know what, I'm just going to pay the minimum monthly. And if it's over 30 years, as you said before, starts to kind of really drag out. Now, one of the other ones, very popular one at the moment. Let's just have a quick chat through. Well, actually, let's start with equity, because I think that's the key to kind of all of this. And I thought real easy breakdown of kind of what equity is. It's, the difference between what you owe on the property and what the property's worth. And now from the bank's perspective, that is true. But what they'll usually only let you utilize is up to 80% of what the property's worth. So very simple one. Let's say the property's worth $1 million. Generally at 80%, then you've got 800 grand worth of usable equity. And if you owe 500 on that, then you've got 300 grand of usable equity. Now, how you use that equity, which we kind of touched on the first point before, was, debt consolidation. So you can use, if you've got 300 grand worth of debt consolidation, then maybe you probably need to be talking to somebody else. But ultimately, in that scenario, let's say we've got someone that wants to do some renovations on the property. That's another key one, isn't it, really?
Yeah, renovations are a big one, especially like if someone's got the equity there and they don't have to rely on an end value, which is something different again. If they've just got the equity there already.
The uplift, the TBE val to say this is what it's going to be worth.
Because people will, even like some of these cosmetic renovations that people are doing. So that's just anything that's not structural. So if you're not taking out a wall, some places will look at a pool as non-structural these days, but most do. So, people start doing kitchens and bathrooms, start doing landscaping, all that kind of thing. That bill can add up pretty quickly, depending on what they're doing. And if they've got the ability to pull that out and then manage it themselves,
obviously more cost effective, right?
Definitely more cost effective. Most tradies will do a cashy for you. So you can, if you can manage that yourself as well, and you've got the ability to, you can save yourself a bit of money there. And the money's on hand. You know, so you're working on your own time.
Yeah.
You're not asking the bank to pay certain trades and that kind of thing as well. So, renovating is certainly a big one, because I think people, if they've got the ability to, like we've got clients that will do knockdowns, but they'll also do like additions to their home. So they'll build a second story. If they've got the land, they'll extend the home, because, you know, they're looking at, okay, I could sell and buy something else, but, you know, if you're talking about $1 million
stamps,
$1 million property, well,
sale costs.
You've got to pay an agent to sell it.
Yep.
And then hopefully get the price that you want. And then you've got to donate to the government on the next purchase with your stamp duty, which is significant, especially for, you know, and those people that have purchased their first home, maybe had some stamp duty concessions, they purchase the next one and they're like, oh, what's this?
There's 30, 40, 50 grand. Yep.
Here's, you know, sometimes 50, 60 grand that you're paying out. You've just paid the agent 35, so you've already lost 110 grand and you haven't even done anything.
Yep.
So some people now will look at,
can I renovate my current place?
Can I renovate my current place, even significantly? So
and so there's two options there then, right? One we're kind of touching on there, which is the renovate, utilizing your equity, where you can get the cash out of the property to do what you want to do, and it's kind of no questions asked. Hey, you've got the not no questions asked. That sounds a bit funny, but they still want to know what you're going to do with the money. But it's kind of like when you go through the approval process, it's like, hey, here's your 100, 200, 300 grand or whatever it might be that you're getting cash out, right? And so what they usually would do is, let's say you had a $500,000 loan. If you want to use that equity, you're then going to have a $600,000, $700,000, $800,000 loan, and that 100,000, 200,000, 300,000 comes to you as cash, literally into your bank account for you to utilize as you please.
Yeah.
And so that is kind of option one, right? With equity, it's like, well, you can pull that money out and therefore utilize it as you please. In the event you needed 4, 5, 600,000 because you're doing these renovations where it might be more structural, you're doing additions or whatever it might be to make the property bigger, go up, then obviously the bank, in order to capture that value, the bank wants to do a valuation based on what the works are going to be once it's completed. So, if it's 500K worth of works, then what you would usually hope to see is if you had a property worth $1 million, maybe it's worth 1.5 at the end, right?
Yeah.
But the difference between those two is then that the bank wants to actually control the funds. So they want to see
a build contract. They want to see all your
invoices or
council
quotes.
Approvals, depending on
the whole shebang.
Yeah, they want to see everything, which is sort of fair enough, because otherwise then you're ending up with potentially a debt which is worth the exact same amount as the property, and all of a sudden you can't sell it. So with the more structural stuff, the banks are definitely a bit more in control. But the process with a lot of them, and especially ones that do construction well, like we know who they are, like it's quite a simple process, really. Long as you get your valuation back where you need it to. Managing it through that process is usually pretty smooth.
And so once again, looping that back to the whole refinancing thing, why it is potentially important. You kind of touched on it earlier, Brad, where you said, well, the valuation standpoint, obviously, I think we've discussed it on here before. CBA will typically, more times than not, we seem to see that CBA will give these really generous valuations. And so maybe you're with another lender that the value of your property only comes in 800 rather than $1 million. So maybe you did want to control it, but all of a sudden it's been taken out of your hands and you're going to need to go and get the build contract, the specifications, the council approvals, got to get all that stuff and submit it to the lender and then hope that the valuation stacks up and then they're going to control it. Whereas if you get a more advantageous val, like someone like a CBA, not saying that that's all the time, but let's just use them as an example, and it comes in at $1 million, well, obviously that allows you to control the process a little bit more and the funds are there available and you don't need to go through the red tape. And I'm not saying that that's necessarily for everyone, but that's why it can be important to obviously refinance between lenders sometimes, because it can be more of a purpose-driven objective as opposed to obviously you always want to try and make sure you get a better rate, but it's less of a rate conversation. It's more about, well, okay, what does this enable me to do?
Yeah, I think, if you always want the lowest rate, majority of the time, or for a lot of people, that bank may not even, you may not sort of fit their ideal client sort of segment at times, and they may not be that good at renovations, and they may make you jump through 1,000,001 hoops to try and even just get 50 grand cash out and whatnot.
Yep.
So it becomes more of, like you said, going to the bank that'll actually support what you're looking to do. Like, do you want to go there and jump through all those hoops, have them control everything so that you can save $15 a month? Or do you want to go to this other bank who's like, here, free reign, which saves you thousands on your overall renovation because you're managing it.
Yep.
Which I always think, you want to, and like people now need the banks that are going to support them in different journeys. So like, purchase your first home, they're with a bank that does the scheme.
Yeah.
Okay, now I need to renovate. So maybe they do land at like CBA, and then all of a sudden, they're wanting to invest or start a business or something like that. And so then they need a bank that does that. So, which, they're not meant to be able to or know who to go to. So I think that's why you need someone in your corner who's aware of what's going on, because like it changes pretty frequently. Like
Absolutely.
you make plans for a client, and then the bank's like, that's just not for us anymore. So you have to sort of pivot and go again. So yeah.
Yeah, and I agree with you. I think that's exactly what it is. I think that's why a broker plays such an integral role in knowing all the policies, having the relationships with all these lenders, knowing who values it well. A
few weeks ago, we had 4 full valuations done. So this is a valuation firm. Professional valuer goes out, and they're ranging from $1,150,000 through to $1,450,000. And this is not the computer. This is 4 people who are experts in their field. And, all of a sudden, you're sort of stuck going towards different banks because that valuer, like their opinion to the bank, trumps everything that the computer valuation system will come up with. So if a valuer comes out and says, this is what your house is worth, sometimes depending on the bank, it could be 3 months, it could be over 6 months.
So
they
that's
will
valid.
rely on that regardless of what you can come up with. And sometimes you have to really push to get someone else out there after a certain period of time. So,
and that hamstrings people then, right? Because if they stay loyal to, let's say it was Westpac in that instance, if they stay loyal to Westpac, well, all of a sudden they can't do what they want to do. Like you want to pull the equity out for whatever it might have been. It might be investment, it might be debt console, it might be cash out to buy into a business, it might be whatever. That's then going to pose issues for you, and essentially you're going to have to wait another 6 months until you get another one done.
Yeah, and you need to take advantage of at the time what you can do. Like we say this to clients at times, like, you've got the ability to do this now. Okay, you want to stay loyal to this bank, but they're not giving you the right valuation. Maybe they will in 12, 18 months' time.
Too late.
But then the clients start a family, someone's only getting half pay.
Yep.
And all of a sudden, it's great. Your house can be worth, we've seen it, clients' houses can be worth millions of dollars, but if you don't service the debt, it doesn't automatically mean that they're going to give it to you. Like if the income's not there to support it, they're not just going to go, oh, your house is worth $5 million. Like, do you want $3 million? It's like, that's not how it works. So
no, good point.
You want to take advantage of the opportunity that you get sometimes, especially if you are looking to invest in a property and you want to sort of look at what the end realised growth will be on those things. Because if you don't take the opportunity, you might just find in 12, 24 months' time you can't do it anymore. And then you and then you will be stuck at that lender.
Yeah, definitely. All right. Probably the key one, the one we're seeing a lot of at the moment, the reason why people are refinancing, and why we're using multiple lenders as well, I will say. Even particularly for one client. So it's not totally out of the realms for us to be using multiple lenders for one client. Quite often there is a bit of a spread there. It won't be like, okay, well, the owner occupied's with CBA, everything's with CBA. It's usually like, okay, we might have one at CBA, we might have one at Apollo or First Mac, and we'll touch on those, why I've kind of mentioned those two in particular for the investment side of it. But let's kind of just touch on briefly how someone might normally utilize equity, structures that we usually come up with, why we don't do something called cross-securitization. Just take us through how someone might normally use equity to go and buy an investment property.
Yeah, so you might have a home that's, let's say it's worth $1 million, and
Yep.
you don't owe too much on it and that kind of thing, and you're wanting to go and purchase a property. You might want to purchase another property that is $1 million. So we'll pull, we'll pull your 200,000 out of your current property.
Your 20% and
So 20%, and then plus your costs. So that may end up,
250.
depending on what you're doing, might be a buyer's agent. Let's call it 250, 275. So you pull that out
as a separate loan.
as a separate loan. So to be for investment purposes, obviously speak to your accountant, but they'll look at what the use of the funds were, and then that goes towards the purchase. So that'll be your 20% plus costs of your investment.
Yep.
And then you've got your pre-approval in place for your investment purchase, which, like you said, will a lot of the times not be at the same bank that maybe your owner occupier is at, and that's because. Yeah.
Oh, sorry. Yeah, I was just going to say. Sorry to cut in. So, and why would that be? What do you reckon at the moment? Like, obviously, I mentioned Apollo and First Mac, just to name a couple. There's more than that out there, but just
how
touch
they
on
treat
that.
the negative gearing impact that you can have on that property. So you may find that your current bank will they're not going to allow you to buy $1 million investment property. They'll give you the equity, and then they'll only lend you another 200.
Yeah.
And then you could go to, say, a First Mac or Apollo, and they'll give you that pre-approval.
Yeah.
Easy
Yeah.
as. And I mean, there's still some really competitive rates out there, but there are some banks that really focus on and really favour people that want to lend in property, through numerous structures and that kind of thing. But they'll favour those people a lot more. And again, like a lot of times, you're not paying big exorbitant rates or anything like that. They just simply, that's what they're targeting.
Yep.
And you take advantage of that at the time. So like we've got clients that might have 4 properties and they're with 3 or 4 different banks because 2 years ago, this bank really wanted the investment lending.
Yep.
Next year they go and buy again, and maybe there's another bank that's popped up and it's got a better rate. So, and scattering it across, especially when it comes to an investment, like your rate can be important and that kind of thing, but who's actually going to let you do it? There's no point in chasing the lowest rate, and you can never actually invest.
Yeah. No, exactly right. And I think the other thing with those two as well is, yes, there's some negative gearing stuff and how they view that. But then there's also the buffers as well, isn't there? They really have a reduced buffer on existing lending and the current lending that's coming in. And some of those, the disparity in
expenses, the rental income that they take,
and the disparity in borrowing is huge, isn't it? Like for some of them, like we're talking hundreds and hundreds of thousands.
Yeah, which, again, you could go in and see Sally in the branch and that kind of thing, and you've done your first property and then you sold it and you bought again, and I'm sure the experience was great, but you go back in and they say, you maxed out and you're loyal to that bank. Well, if you don't ask the question, you'll never know.
No.
And traditionally that was the way, the bank said I can't borrow anymore, and we get that now, the bank's not going to let me lend anymore. It's like, which bank? There's
so many options.
There's tons of options out there now for people, and there's a lot of banks that people have never even heard of. But
Correct.
It's like, well, you're the type of client that they're after because you're looking to invest in property.
Yep.
They're not going to put a 3% buffer on all your repayments and that kind of thing. They only have a 1% buffer, and they won't shade your rental income as much and give you those negative gearing benefits. And then all of a sudden, people can start to build their
investment portfolio
up. So it is something that we are getting a lot more inquiries about with different structures and that kind of thing. But I think it's just educating the clients on what's actually out there, because you may not build your property portfolio of your dreams by sticking with a Big Four forever.
No, so true. And so just breaking down that kind of scenario that we're talking about. So let's say someone had $1 million property, they were going to buy $1 million property. What they would essentially end up with is 3 loans, right? So one would be the existing owner occupied, let's just call it 500 again. Then they've used the equity in their current property and borrowed, the 250, which is the second loan. So it's like an equity release, we call it. Once again, like it was explained through the renovation, that just sort of comes to you in cash. You borrow the money, comes to you in cash that you can then utilize as your deposit and costs for your next purchase. And then you've got your third loan, which is actually secured against the new property, which is for 80% of the value, which would be 800 grand. And so in a nutshell, I know that's a really just common question that we get is like, how does the equity actually work? What's it going to look like? And in a nutshell, that's quite commonly what we'll do is loan A will kind of remain the same. We need to utilize the same bank, or a new bank, but those two loans over that property need to be with the same lender. And then you do your third loan with against the new property with whoever it might be at the time.
And like you were saying, like with, why you don't want to be cross-securitizing. And you'll see, like, if someone's bought an investment property or two and they're with Bank A and they've been with them forever, it's all cross-securitized. So, then you've got to go through and, like, untangle it and, like, maybe you want to sell one and then all of a sudden you've got to pay down the debt a bit more. Like, you speak to an accountant, they're going to tell you to keep it separate for sure.
Yeah.
Because you want to make sure that your properties are separate and all standalone. And then you've got your statement for loan 1 and 2, much easier come tax time and that kind of thing. But we do see people that have got 3 or 4 properties and they're all intertwined and you're just like, why has this even happened? And it can be a bit of a nightmare at times to untangle them, because if you sell one of them, then the bank's going to come to you and go,
you need to pay down.
We actually need you to pay down the loan by X. And you're sitting there going, well, it's another 100 grand that I was
You might have banked on, pulling some of that.
X
of course.
Thinking, because at the same time, you've got all those properties together. The bank's valued them all and said, we're telling you what they're worth. I know you might think you can get a bit more on the market. This is what we're telling you they're worth. And that's why now we need this other 100 grand. And then that stumps plans for the next thing. And all of a sudden, great idea at the time because it got you the property. And most people don't even know their loans are tangled.
No. And they don't find out until they've given the discharge form when they've got a contract on the property and it might be already unconditional. And then it's kind of like the bank comes back and goes, well, wait a minute, this one's attached to this one. So essentially all the loan, like for anyone that's listening here, cross-securitization is when, let's say once again, you've got 4 loans and you've got 4 properties. Essentially they're all crossed in, they're all securing each other. And so
you can't do anything with one without affecting potentially
absolutely
the others. And like with those valuations, if you're with that bank that doesn't give the generous valuations, you're stuffed.
Yeah, absolutely.
Essentially, like you're stuck in the mud. Yeah, and
you're so told what to do by the bank, like and that's obviously the strategy of not having things cross secured, because you can go and sell something. You're not told to do what the funds. Obviously, you've got to clear the loans that are attached to that to that property. But outside of that, you can continue to do what you want to do, which is
and you might have
which
a
is the
property
advantage.
that's in a certain area as well. Like that's something that, and there are banks out there that you might have a property that's, up in the northwest part of the state and that kind of thing, where the bank would only now lend 60 to 70%. And sometimes they'll look at, okay, everything you've got now is capped at that limit.
Yeah.
When you've got other properties at 80%. So you've just cost yourself hundreds of thousands of dollars in usable equity again. And it's going to leave a really bad taste in your mouth as well when you go through that experience.
So the underlying message today, it's fair to say, is obviously there is a plethora of things that you can do with equity. I think the real message is that, the value of your property is so important in understanding what that looks like. Obviously, it loops back to the conversation around refinancing, because once again, the bank you're with right now might not suit your purpose moving forward. And also there's potential cost savings and those types of things. So I think for anyone out there that's listening, that's interested in refinancing, go and reach out to, usually we do say broker or bank, but honestly go and speak to a broker, because it's going to open up all those opportunities and the abilities to do everything that you might be looking to do. It also gives you the options, like with access to over 60 different lenders. It's not a matter of you having to sit on CanStar or Finder or one of those ones where you're trying to find the best rate and sift through what product it is. Find a really knowledgeable broker that knows their stuff, can get some valuations done for you for free, don't cost you any money, and let you get an understanding around what the equity position of your property is and how you can best utilize that, and whether it's getting a bit of a debt consolidation to get you out of a bit of trouble, whether that's you want to go and buy a car or a caravan or whatever it might be, a boat, I don't know. Or it's you want to renovate your property, whether you want to do it via the options we mentioned of managing yourself versus going with a builder. Or it might be that you're looking to start your investment property journey. So, mate, I just wanted to say a massive thank you once again, as always. Pleasure seeing you here and pleasure having a chat again. And, mate, no doubt I'll have you on again soon.
Touch soon.
Cheers.
Thanks, mate.